Hey everybody, welcome to Money's No Object. I am your host, Dylan Howell. This is episode number 12 of the YouTube channel and podcast. And I am extremely excited to continue working with you guys and continue teaching you and learning with you as we move forward in this financial action plan, which is where we are right now. But just in this channel in general, I just hope that we can continue to provide the knowledge that you're looking for and the information that you're looking for, and hopefully you provide us with some feedback and we can just continue that relationship and build it moving forward as we provide you with more and more of this free content. So today is actually my favorite topic in the financial action plan. It's probably the one that is just the most interesting and nuanced and extremely important to your financial future. And it's all about investing, and it's all about how much you should invest and what you need to be doing as far as your investing goes. I'm not providing you with any specific investment advice. I'm just telling you that at this point you need to be doing these things. You need to be investing a substantial portion of your income toward the future and toward where you're going to be down the road. That way you have money and you don't have to worry about where your money's going to come from later on. So what we're going to particularly look at is when it's important to start investing a substantial portion of your income and what that looks like. What does it look like to start investing? And if you've never invested before, or if the third step where we started investing along with the employer match, if we had one, if you don't have that and this is your first time to invest, then I'm really excited to talk to you, and I'm really excited to move forward talking about these things that are so important and so integral to growing your money moving forward. So just a quick recap of where we are in the plan. So what have we done to this point? Well, we have budgeted, right? That was the first step. Step two, we built 1 month worth of expenses into an emergency fund for things that may arise that were not expected. And so the emergency fund is there for that. Then we went to step three, which was your investing up to the match of an employer sponsored retirement account if you are offered a match in an employer sponsored retirement account. If you're not, you weren't supposed to worry about that particular step. You could learn something from that video, but that step may not apply to you now. Then step four was pay off all your consumer debt other than your home. And that's such a huge thing because that'll get you to a point where you actually have money that you can spend and that you can give and that you can invest in this step that we're going to talk about today. And then yesterday we talked about building that emergency fund up from 1 month of expenses up to 4 to 6 months worth of expenses. That way we can really put a cushion between ourselves and the things that life may bring to us, because as we have more money, there's just going to be more opportunity and more things that can be affected by tragedy and by emergencies. Now it's time to start building your real nest egg. I'm sure a lot of you have heard it called that. It's time to start building that real nest egg, and this is the money that you're likely going to retire on. This is the money that you're likely going to be spending to do all the fun stuff in the future. And so now's the time that we're going to start building that up. So you may say, Dylan, well, what does investing even do? Why is it that important for me to be investing? Well, we don't want our money to be worthless, right? We don't want the thing that we worked for and the thing that we were working to attain our entire working life to be worthless. And if you put money into just a savings account, which is absolutely better than nothing, if you're just saving into a savings account, it's better than nothing. That makes your money worthless. That's making your money actually go backwards in value in a lot of cases. Because if a lot of you've heard of this idea of inflation. Inflation is simply the increase in the price of goods over time. And so if the increase in price of goods is greater than your increase in the money that you have, the growth of the money that you have in that savings account or money market account or whatever, then the value of that money is actually going backwards. The value of that money is actually going to be worth less later than it is today. Therefore, when we're investing here, we're not looking to get crappy rates of return, and we're not looking to invest in things that are just going to allow us to house our money. Although that is an extremely important thing to do, we're looking to grow. We're looking to do things to move our money forward. So what does investing do? It compounds your money. And you may say, well, what do you mean by compounds? Well, if let's say I invested $100, right? Just for simplicity, you invest $100 and that $100 were to make 10% this first year. Well, how much money do you have at the end of the year? $110, right? Well, let's say it remains invested and the next year you also make 10%. Well, then how much money do you have then? Well, it's not just another $10, it's $11 because now we're not growing 10% of the original 100, we're growing 10% of the 110 that you started that year with. And so you would make $11 that year, and the next year you would make $12.10. So it compounds on itself, and you're making interest on interest. So when you hear compound interest, that is nothing more than you making money on the money that you've made. And that's how investing can get you to wealth. That's how you can build wealth in a sustainable way, is having money that is compounding, that is growing consistently for you. And investing just helps you to make a brighter future. Obviously, a lot of people invest for retirement, and you should invest for retirement. And so that gives you a view of where you're going to be down the road, or where you're going to be very soon, that is brighter, that is better, that is more fulfilling and a happier place than maybe you thought you could have gotten to. It can also change your children's lives. If you're saving money for your children's college actively, or for them to get a good financial start and to do certain things and saving, so when it's time for them to get a first car, they can do that, or whatever it might be, you can change the trajectory of your children's lives if you simply start investing for that purpose now. And so investing is going to allow you to do these things, and essentially what it's going to allow you to do, if you've worked sequentially through these past steps, these past 5 steps to get to step 6, to get to this episode, then you're going to be so content and so happy with where you've worked from, and you're going to be able to look back and go, I don't want to go back to that place, and I don't want to be there again. So I'm going to grow forward. I'm going to make the conscious effort to invest my money and try to do good with it, and try to change the lives of others and continue to change my own life with that money. So now to kind of get down to brass tacks, how much should you be investing at this point? Well, what I would say is start investing at least 15% of your income. And you may be saying, whoa, Dylan, 15% of my income, that's a lot of money. Yeah, that is a lot of money. But I have a little caveat for you, a little something that you may have forgotten. You were just in debt not long ago. A few steps ago in this plan, you were in debt, and you didn't have an emergency fund, and you didn't have savings for things that you needed to have savings for. Well, guess what? Now you do. Now you don't owe anybody any money. 15% of your income is chump change to most of you when it comes to the amount that you are paying creditors for the debt that you owe. 15% is nothing. So if you were paying 25% of your income on the debts that you have, and now you just need to save 15% towards retirement, or towards just some kind of investing for the future, then now that's an asset to you. That's money that's growing forward that you have at your disposal. It's not something that you're just throwing away. So if you could have done that, you can do this. And past looking at just a percentage, what you really need to look at minimum, is the money that you put away each month needs to be money that will grow to an amount that you're comfortable to retire on. And if you're saving for your kids' college, an amount that you're comfortable them having when it comes to going to college, or doing whatever for them that you want to do moving forward. So at minimum, it needs to meet your needs. But typically what's going to help meet your needs is somewhere around 15 to 20% of your income. And you can invest that 15 to 20% in a number of things. And I'm not going to provide you with specific recommendations here, but you can invest it in several things. There's stocks, bonds, mutual funds, exchange traded funds, real estate. All of these things can grow your money forward. And so that would be something that you could talk specifically to somebody like an investment advisor to really see where you need to be as far as moving that money forward and growing that money forward long term. But those are particular places that and particular things that you're probably going to see. And overall, what we just want to make sure that we're doing is making a good rate of return, growing forward, hopefully at the rate of the market long term. You may be in a place where you need to be a little conservative, but hopefully we're making at least a market rate of return moving forward. And if we're doing that, then building long-term wealth should not be a big problem if we're saving enough of our income to do so. And what you might be really interested to know is that, Dylan, you're comfortable with only making a market rate of return, like the rate of return that the market provides. Well, yeah, and here's why. The return that you make on your money is not the largest contributing factor to you having money in retirement. It's extremely important, and I'll talk way more about it, but it's not the primary contributing factor to you retiring with dignity. The primary contributing factor is you actually saving this money, is you deciding that you're going to invest and actually putting money in and doing what you're supposed to do. And if you're actually doing that and making a reasonably good rate of return, then you should get where you need to get. So don't get so caught up in return that you don't invest, that you don't actually put the money in. Don't get me wrong, do your research, analyze the investments, do what you need to do to figure out what's best for yourself and grow your money the best that it can be grown. But don't just sit there and do nothing. Do something. Put money in, invest your money for the future, but do it in a way that's prudent. And if you need somebody to help you actually do that, and investment advisor representatives can help you do those types of things, but have a plan when you go to them. Don't just decide that you don't have a clue what's going on. They can help you learn, and you can find somebody who can help you learn. I know that Dave Ramsey, who is a financial personality, and you can find him. He does a lot of endorsing of these, he calls them smart investors. They're just financial advisors and investment advisor representatives who he says has the heart of a teacher. And that's really what you want. You want people who will help teach you. That's what I'm here to do. I'm here to help teach you about your personal finances, but those people can actually help you put the teachings into action. And so you can find somebody to help you do that if you can't do it yourself, if you cannot do the things that you need to do by yourself. It's not extremely difficult to learn about, and we'll talk about a lot of things investment related here that you can learn, and hopefully you can take and do a lot of things on your own. So where are we going to be putting some of this money? Where are we going to be investing this money? Well, we need to be putting this money in things like IRAs, where there are tax advantages to putting that money in, and we need to be putting this into employer sponsored retirement accounts, like we were talking about earlier with the match in step number 3, where we are receiving something from the employer, something that's beneficial to us. So we can put money there, put money in 529s or other educational savings accounts for your children that they can use for college. Or put your money into brokerage accounts that have a lot more flexibility, but not the tax advantages that retirement accounts have. And so you have all these different choices, and we will dig into these things moving forward. But just know that those are the particular places that we want to be here. And hopefully as we move forward, you'll see some of those other videos that I do talking about these specific types of accounts. And you'll be able to come back here and say, okay, well, if I'm in that step, I can use this information that he's given me to put this into action. So you may say, well, Dylan, you say 15 to 20%. What's the maximum that I can do here? What's the maximum amount? Well, that's going to differ by account, first of all. So as we talk about those accounts, you'll learn a little bit more about where you need to be as far as the amount that you can put in. Also, we want to leave some room here. And what do I mean by leave some room? I mean, we don't want to use every extra dollar that we have at this point to put in investments. But you might be saying, but Dylan, I don't owe anybody any money. I don't have I don't have to build any more emergency funds. I'm not using all of my money. Why can't I put more away? Well, here's why. We haven't really gotten to paying off the home. And you may be somebody who has your home paid off. If you do, bravo, that's fantastic. And in that particular case, you can really stack on to investments, and we'll get to that in a financial action plan step as we move forward. But at this particular point, you just need to be where you're leaving room to put extra payments on your house. You want to get that asset paid off to where now you own something else that's going up in value and that you're not consistently paying into. And something you do need to make sure of is that you're not doing any investing that is outside of the realm of what we're talking about, or any other savings that is outside of the realm of what we've talked about. You should have already saved for your emergency fund. So that's set, that's done. You should be putting money away for the things that are recurring or that are coming in those sinking funds that we've talked about previously. Now, everything else that is in the savings column should be going towards these investments. And so you may say, well, Dylan, I just don't understand investments. How am I going to be able to do this? This is too complex of a subject. I haven't learned about all these things. I don't know. So why should I do this? Well, first of all, if you don't understand, it's better to set and do nothing than it is to invest in something that you don't understand. And the reason for that is that you don't want to get duped. You don't want somebody to pull one over on you and make you lose a substantial amount of your own money because you didn't understand what was going on. And it happens all the time. The biggest example, and the example many of you have probably heard of, is Bernie Madoff, right? During the financial crisis, Bernie Madoff was caught in one of the largest Ponzi schemes of all time, and he was literally taking money from investors and putting it in nothing and forging statements and all these types of things. So he was very complex in what he was doing, but it's because people weren't asking questions. They believed that he was an expert and he knew that what was going on, and you don't need to be there. So knowing what you're doing is so important, and knowing where your money is and having proof that your money is doing XYZ, so important. And there are a lot of safeguards against that now, but just don't be investing if you don't have an understanding of what's going on. And if you don't understand, keep watching these videos. I am going to help you learn. I am going to help you learn how to navigate this particular area that people think is extremely complex and extremely strange. And it can be, but it doesn't have to be for you, and it doesn't have to be for your personal finances. And so we're going to work through this together, and I just want you to understand that we will get there, and to have a little patience with me. I can only fit so much in a 25-30 minute video. And so as we move forward, you will get more of this content and more of this information. And you might also say, well, investing, you mean the stock market? How am I going to trust the stock market? And that's not all that I'm talking about. Like I said, I alluded to real estate earlier. I alluded to bonds and fixed income and things like that. But yes, the stock market is a large part of investing. It's a large part of what you actually hear about investing as well. And I want to make a couple quick points about the stock market as to why you shouldn't be afraid of it. First of all, are all the big companies going to just go out of business all of a sudden? Not likely, right? You think Walmart and Amazon and Apple and Target and Home Depot and all these places that you know of and that are very familiar to you and are some of the most valuable companies in the world, do you think they're just going to go away? And if you don't, then there is still value in the stock market. There's still value there to be had. It's not me saying to invest in any of those companies, particularly like the specific company. It's just me saying that those companies are still going to hold value, so the market as a whole will still have some value to it. I actually just looked last night at the returns on the S&P 500, the most commonly looked at market index for the past 40 years. So I looked from June of 1980 to June of 2020. And if you had invested, the rate of return with your dividends reinvested, which we'll talk about later, was 10.782%, which is a fantastic rate of return. So just knowing that for the past 40 years, I'm not saying that that happens for the next 40, but knowing that that is something that long term created a lot of value, it's not necessarily something that you should just fear. And the reason that you fear it is what? Is that all that the news is ever talking about is the bad. When people are fearful and when people are scared, it sells. It's what is going to create viewership. And I noticed, particularly as somebody who was really diligent about having a level head when the market fell real hard amid the coronavirus panic, is they immediately started doing these extra shows called things like Markets in Turmoil, and the pain caused by the market, and everything was breaking news and everything was in red on the screen. They wanted to convey fear to the people who were watching, and that's the thing that has you feeling the way you do. It's not logic. And so take a step back and just think about what the market is, and you'll probably get yourself to a lot better conclusion than what you have currently. And ultimately, knowledge helps stomp out fear. So if you are afraid, knowing more about it is going to help you to feel better about it. And watching this channel and listening to this podcast is going to help you feel better about the investment choices that you have and the things that you can particularly invest in, and actually putting your money in those things. And it'll help you sleep at night. So if you have the knowledge, your ability to deal with the volatility or deal with the fear and anxiety, it will be a lot better if you actually have the knowledge and know deep down what's going on with your money, as you definitely should. One quick aside is just that I want you to remember that I spoke about the Bernie Madoff thing. Advisors can be extremely useful, and advisors can help you put your plans into place and do good things, but they are not your money saviors. I want you to know that they are not people who in all cases are going to do absolutely what's best for you. And some definitely will. Some will definitely do what's best for their clients, and some will definitely go out of their way to teach you about specific investment choices. But you cannot trust that they're just going to do exactly what I talk about or exactly what you think they should do. You have to hold them accountable. There has to be some level of accountability between you and them. And that being said, I really, really, really believe that they can be useful. I really, really, really believe that they have value, but you just have to be diligent. You have to remember that it's your money. You have to remember that at the end of the day, the losses aren't coming out of their pocket because you lost money as much as it's coming out of your own. So just be diligent, do your homework, and use them for what they're good for, and just don't overpay. And we'll talk about fees and stuff later, but all that just kind of comes down to be diligent when it comes to using investment advisors. So what this video is really doing is providing you another step and providing you a way to move forward. I can't provide you, like I said earlier, all the education that you need on investments in a video. And that's why I'm going to do a lot that I can to teach you moving forward about the particular tenets of investing and the concepts behind investing that are so important for you to understand. But can't do all of that here. So what I want you to know is that you have the ability to continue tuning in, and you can continue to learn from the things I'm going to teach you. And it's, if this is the only place that you're getting your financial education, first of all, that's an issue, but you're going to have to be patient as well. You're going to have to be patient with me as I continue putting out all the content that I can, because it is very nuanced and there are a lot of topics that can be covered, and I will cover those. But the tenets of investing, the things that are extremely important, we will talk about it, and hopefully that will help you to add value to this step as you move forward. And this is a long-term step. This is not something where you're having to do something just once, like when you're paying off debt or when you're building your emergency fund. There is no end point. So you will be in this step for a long time. And so my videos will likely catch up with where you are, and that'll help us both to build a conversation around where you are financially, and build a conversation around what needs to be happening as far as investing and where you're putting your money and things like that. What's more important than anything is that you understand and that you start. You start building this good habit of investing 15, 20 or more, depending on where you are, percent of your income, and invest it in things that are going to help you grow forward. And that's the point. We want to make sure that we're doing these things, and we'll dig further in, I promise. I just want you to know that's where you need to be at this point. Once you've built that emergency fund, you need to be investing heavily. You need to be pushing the envelope when it comes to investing and building your wealth. So is this it? Is this, we're investing now and we're investing for the future. Is this all that there is? No, this is a concurrent step. This is a step that we're going to do alongside another particular step. And that's the one that we're going to talk about moving forward, is you paying off your home and paying off your residence. And what this particular step does, in lieu of doing that, is it starts building your money in one place while you're paying off this asset in another place. So regardless, you're owning assets in both places, although your investing is definitely going to outperform and outlast the value of the home moving forward, in most cases, in a vast majority of cases. But both need to be done. That way, once you're at that point where you get that house paid off, then you have even more money to pour into investments and to give and to spend and all these types of things. More and more financial freedom. That's something you should notice, is every particular step is providing you a greater amount of financial freedom. And that's what we want. So this step, it never stops. You're going to continue investing until the cows come home, or until you retire, until you need to take the money. Until you need to live off the money, you're going to keep investing. And you may invest past that, but until you need to consistently live off of that money, then that's kind of where this step comes to a close. But like I said, it is going to work concurrently. You may say, where's all this money going? Am I going to be able to get to it? Well, it's all going to depend on the accounts that you put it in. And hopefully we're putting this money away with the idea of not touching it, with the idea of letting it grow and not having to pull out of things that are increasing in value. We want those things that are compounding, that are increasing in value, to continue to do so. We'll talk about all this stuff and more moving forward, but I want you to understand that today was all about getting you to this place, getting you to this step, and we'll help you continue walking through this step with specific details and actionable things that you can look at and do moving forward. So the world of investing is new to many. It is fun, and it is necessary. It is necessary to get you to where you need to be financially long term. I want you guys to start doing this. I want you guys to get to this step and start investing for your financial future. Don't deny your investments in order to spend crazy amounts of money. Now, little caveat, at this step, you should be buying some things that you want to buy. You should be doing some things that you want to do. You should be financially thriving in a way that you've never done so. And that's part of the reason why I said I don't want you to put all your extra income into this step, although some people are just so fired up and wired up about this step that they'll do so. I want you to have that margin, because you've done a lot of sacrificing to this point, and you've done a lot of good in your financial life. And I want you to enjoy. Now, that we've talked about financial balance in the past. You need to be balanced financially, and one of those pieces of financial balance is actually spending your money. And so in order to be financially balanced, you need to spend. You need to buy the things that you want to buy. And so do that. Be diligent about keeping that balance in your life. So have that little bit of extra in your income, and allocate that to things you want to do. I'm not a person that's just saying have no fun and only save and give and invest and all these types of things. No, I want you to have fun. I want you to enjoy your money. That's one of the reasons why it's there. But just don't, that's not something that people tend to have a problem with. The thing that people tend to struggle with the most is the saving and investing and giving. And so I really harp on those things because they aren't being done in large amounts. And so I want to really push you guys into these steps. So hey, thanks again for watching this YouTube channel, watching this video. If you haven't already, go click the big red subscribe button, like this video, leave me some feedback in the comments, and I will reply to you. Also, follow us on social media at MNO with Dylan, and check out our website for the financial coaching services that I offer at www.mnowithdylan.com. You can go check that out. There's a lot of stuff there that may help you. You can also see the latest podcast episode, the latest video, and see all that on our website. It's all there, and read a little bit more about who we are, what we do. So tune in tomorrow as I talk about something that a lot of people think is impossible, and that's paying off your home. So we're going to really dig into that tomorrow. Also, don't forget that I do post weekly rewinds at the end of every week on Saturday mornings, and you can check those out in order to see the big topics of the week without getting down into a bunch of the details that I get into. And maybe it sparks you wanting to watch the other videos. I really hope it does. And so you can check those out then and there. So hey, thanks again for tuning into this episode of Money's No Object. I hope you all have a great rest of your day. I'm your host, Dylan Howell. God bless.